Okay, so everybody, I'm Matthew Burke. I'm a partner with, thank you, Jeff. I'm a partner with Cerini Associates. I've been with Ken since 2002, which is dating us both, sadly. I'm here to talk to you about accounting standards updates that affect nonprofit organizations. It's really not the most exciting subject. I'm sorry I lied to you. Please don't hold me responsible for the content of this, though. I'll try to make it as lively as possible, and that's not easy. So I'll give you a quick rundown of what I want to accomplish here. So first of all, there's accounting standards, right? Where do they come from? We all know, well, we don't all know. Accountants know that double entry accounting started in the Renaissance. It was some Italian friar, right? And we've come a long way in 500 years. Now we answer to the FASB. So who is the FASB? It's the Financial Accounting Standards Board, and they're the ones that create and change all the different accounting standards that all companies have to follow if they want to be in compliance with United States generally accepted accounting principles. We love acronyms, so I'm going to refer to these acronyms. If you don't know what they mean, make a signal and I'll point them out. But generally accepted accounting principles is GAAP, Financial Accounting Standards Board, FASB. It was founded in 1973. It's an independent private sector nonprofit organization itself, based up in Connecticut. It's the one that sets, like I said, the financial reporting framework that you as nonprofits and really other public companies and other companies have to follow. There's 7 members of the FASB board, and there's a ton of other staff that are out there trying to gain an understanding of what current issues are that are facing the general public. The whole point of accounting is to produce accurate financial information that stakeholders can make informed decisions based off of. That can be stockholders when you're talking about publicly traded companies. For you nonprofits, it's you yourselves, the boards, it's the management, it's donors, it's the general public, it's whoever you're reporting to. So FASB exists to try to make the accounting standards as transparent and useful as possible. So the FASB itself, they have diverse backgrounds. They come from different walks of life. They come from big accounting firms. They come from private sector. They're supposedly independent. They have to sever ties with their public, with their commercial interests before they take a seat on the FASB, because obviously they could influence what accounting standards are, and that could affect their own commercial interests. So they don't have that. In short, though, to boil it all down, these are the guys and gals that change the accounting standards. And why I'm sitting here talking to you today is because a lot of changes have happened and are happening that affect you today and will affect you in each of the next couple of years going forward. And really, it's always evolving. It's sort of a self-fulfilling thing. These board members at the FASB create changes kind of to keep themselves relevant, right? Because they can never admit that it's all ever been right at one point in time. They have to always modify. So how do these changes happen? Why do they happen? They identify financial reporting issues. They decide whether or not they add projects to their technical agenda. They deliberate. This whole process takes years. So the first and really most important standard change that I'm going to talk to you about today was issued in 2016, and it probably started 3 or so years before that. So these really move at a snail's pace. A lot of people have insights and provide feedback to the board at public roundtables and things like that, so that the FASB board is trying to listen to the public before they just come out and make authoritative changes to everything. It's supposed to be a collaborative approach. It generally is, but you really can't make everybody happy. So you may sense a tone of resentment or sarcasm when I talk about some of the changes, because frankly, as much as they've changed things, not much really changes when it comes to certain aspects of their deliberations. Ultimately, the last bullet here is really what's important. They issue these ASUs, Accounting Standards Updates, after they've gone through all of their due diligence and all of their process of vetting out potential changes and releasing them to the public. And realistically, about a year or so, maybe 2 later, after these ASUs are issued, the effects become real life and something that you have to worry about. So in the next page here, I've outlined, there's 9 accounting changes that maybe we'll discuss. Really, the first 4 are the most important. If we don't get to the last 5, I won't really be upset, and I know you won't be upset, because who really cares about intangible assets, right? Who even knows what they are? But these are changes that may affect you. The first 4 certainly will affect you. The last 5, maybe not. If we get to them, great. If not, not a big deal. Really want to focus the attention on the ones that are more relevant. And the first one, which is the most relevant, is a new financial reporting framework for nonprofits. So in August of 2016, ASU 2016-14, 2016 indicates what year it was issued, the presentation of financial statements of nonprofit entities came out. The intended purpose there was to make nonprofit financial statements more understandable, more transparent, include more disclosures, and provide more useful information to readers of those financial statements, stakeholders, again, the general public that are deciding if they should give money to you, government authorities who are overseeing you and making sure that you're doing things properly, and internally, of course, to make it just more transparent and more obvious about the financial standing and operations of your nonprofits. This is effective now. So if you're a calendar year-end filer, 12/31/18, your reports, your audits, your reviews will reflect, should at least, if you have the right accounting firm, these new standards. If you're a June year-end or after December 31st, fiscal 19, you will have those. So these are present day changes. We, as an auditing firm, are just going through these first round of changes for our clients for 12/31/18. Not a really huge impact, but it is something that you might notice if you pay close attention. It's applied on a retrospective basis, which, what does that really mean? It means you have to restate and present past years as if it was in effect in those past years. So if you're reporting your financial statements with a comparative showing 2 years, 18 versus 17, 17 has to conform to these changes as well. And as you'll see as we go through this, they're mostly cosmetic, so that's not a huge undertaking to restate the prior years. What it does, besides changing some net asset labels that we'll go through, it also requires a statement of functional expenses, and it adds certain disclosures about liquidity and the allocation of those expenses. So let's start here with net assets. Previously, net assets were presented in a 3-tiered classification system: unrestricted, temporarily restricted, permanently restricted. Those 3 are moving to 2, with and without restriction. Not really earth-shattering, right? So the content of the financial statement shouldn't change all that much as a result of this labeling change, because in the past, you really should have been disclosing in full length your significant temporarily, your significant permanently restricted. If there's any designated net assets that's considered unrestricted. That should have always been in your financial statements anyway. So again, if you're using the right accounting firm, or if you're doing your financial statements yourselves and disclosing the way you should, this is really a matter of changing labels in the financial statements more than anything as it relates to that. Underwater endowments, we'll talk about on the next page. There are some changes as to how endowments and those that are underwater, which I'll define, are reported. There's also a change for the release of restrictions on the acquisitions of long-term assets. So net assets that are restricted can be released from restriction, right? If I give you $100,000 for use in a certain program and you use it on that program, it gets released and goes to unrestricted and comes out of your operations. For long-term assets, there's a bit of a change. So the new standards require that once the assets are placed in service, it becomes released from restriction. You can't release it over time. So if it's for a building or something like that, you can't release that restriction over the course of time. It has to all take place when it comes into service. Again, it doesn't affect a lot of you, probably very rarely, but it is a change that's out there. Board designated funds are often misunderstood. So a donor can restrict a net asset. A board cannot. In an accounting sense, the word restrict obviously in the English language means something different. From a technical standpoint, if a board sets aside funds for a specific purpose, it's designated. It's still unrestricted because the donor hasn't said you can't use it for that. It's not really a legal obligation. It's something that can be undone by board vote or a resolution or something like that. So it requires now that full disclosure of board designated net assets be included in the financial statements. Again, I will say, and Ken will echo, you probably should have always been doing that anyway if it wasn't specifically written anywhere, because a reader of the financial statements will want to know if any of the unrestricted net assets are set aside for some other purpose by the board. We'll talk now about some endowment funds. Endowment funds can be established either by donors or by the governing body. So if it's by donor, it's restricted. If it's by the governing body, it's designated, but still unrestricted or without restriction. So a donor restricted endowment fund results from a gift with a stipulation that those resources be invested for either a long-term specified period of time. There may be provisions about the use of income, whether that income can be used for operations and unrestricted, or that income, investment income, usually can be temporarily restricted for a further purpose. You can tell I'm mixing and matching the verbiage because it's basically the same, with restriction, temporarily restricted. And then, like I said, a board can designate certain endowment funds that it wants to set aside. We see oftentimes that boards that have significant financial resources don't want to keep that all in general operations. They want to set up an investment policy. They want to sock money away. They want to generate income. and they want that to really survive and provide a perpetual stream of support for the organization. That's a board considered endowment fund. An underwater endowment fund means what? It means that the balance today, the fair value of that fund, is less than the original principal that was invested. If I give you $1 million, you put it in and it's restricted for perpetuity and you can only use the income. If that, because the stock market crashes, drops to $500,000, it's underwater by $500,000. So there's an accounting standards change as to how that $500,000 needs to be reported. In the past, prior to this ASU, accumulated losses, so that decline in value, the $500,000 using my example, was treated as a reduction of unrestricted net assets. The change now will keep that net asset loss in the restricted column, so to speak. So in the past, it would affect operations in a sense in the financial statements. The FASB said that really doesn't make sense because it's a loss of value in a restricted fund. It should stay in that restricted fund. So again, that may not apply to many of you. How many of you have endowment funds of any kind in your organizations? All right, so 5, let's say. So these are the ones that really are important changes, and they don't apply really to everybody.
Just one comment on that. If one of the things you have to do under this is, remember Matt said that things have to be retroactive. So you actually have to go back in time and look to see if in prior years the funds were underwater. And if the funds were underwater in prior years, you actually have to class from unrestricted because you put the loss in unrestricted the prior years. You don't have to move that loss back to permanent restricted or with restriction.
So also as it relates to these underwater endowment funds, there's disclosure requirements. So disclosures for the lay people, if you don't know what that is. So the financial statements are laid out with your statement of financial position, your balance sheet, your statement of activities, which is your P&L, statement of cash flows, your statement of functional expenses, the numbers part of your report, right? And then everything in the back is considered the disclosures that supplement the numbers part. So in those disclosures about underwater endowment funds, there's a lot of more information that has to go in there. The governing body's interpretation of the ability to spend from those endowment funds. So the board may have certain restrictions where if you have an underwater endowment, you can't use it the way you would if it was above water. The policy and any actions taken concerning appropriation. So if you can pull money from that underwater endowment or not, and how much you did. And then the aggregate amounts for the fair value of those funds, the original amount, and any deficiency that's in there. So again, this isn't all that different than what you've been presenting in the past, except for the fact that if it's underwater, it will stay in that restricted column. Keep saying column because that's how the financial statements lay out. So here's a quick illustration of the changes. Prior standards are reflected above. Your net assets are either unrestricted or designated, which remember is unrestricted, temporarily or permanently restricted. Under the new standards, the $2 million from the unrestricted and the $600,000 from the board designated are considered without donor restriction, and then the 400 and the 100 of temporarily and permanently restricted, respectively, are now with donor restrictions. We're just moving numbers around and changing names of things. In the financial statements, we should still have the same level of detail, maybe a little bit more on what those restrictions are, whether they were previously permanent or temporarily, really doesn't matter. Should always be disclosing to the reader of the financial statements what the nature of those restrictions are, because it's very important to them to know if your funds are set aside for a different purpose than operations. Yes, in the back.
The new standards, you have what the price standards have what designated funds.
The new standards, they're here. They're without donor restriction. Yep. The 2 million to 600 get to the 2.6. Yep. Something else that's new now. Liquidity. So what is liquidity? Why is it important? A classified statement of financial position, remember that's your balance sheet in a sense, is now required. It was always best practice in the past. It's something that we as a firm always did for our financial statements that we issued because we thought it was more transparent and offered better information to readers of the financial statement. The new FASB standard is just forcing people to follow that. Again, probably shouldn't apply to you because you might be doing this already. But what does it really mean? So you have to break out your current assets and your current liabilities. The term current in this case means it's going to be a use of cash within a year for a liability on an obligation that existed at the end of the year, or it's going to be a source of cash, a conversion to cash of a receivable or a prepaid or something like that then a 12-month period of time. That's the key term, 12-month, 1-year period of time. The point of this is you want to see that you have the financial resources to get through a short period of time, a normal operating cycle, instead of just having this positive net asset. And I'll show you on one of the examples here. But somewhere where it comes into play is if you have significant restricted investments, or if you have significant level of your net assets tied up in property and equipment. It looks good on paper. It shows that you have positive net assets, but you can't pay your bills or your people with your chairs and your fixed assets. It's not convertible to cash readily. I mean, you could sell it, but chances are it'll take you a period of time. So the FASB is saying it's important for organizations to show what their liquidity is, how much current assets they have versus how much current liabilities they have, and what's the difference, and how they're managing their liquidity to get through a normal operating cycle. So between the current assets, the current liabilities, and now ordering the financial statements in terms of liquidity, so what's going to be a conversion to cash first, you know, your cash, your receivables, and then way down that list will be your fixed assets because it takes time to sell. We have to disclose how the funds will be used and the liquidity of the assets. Again, this is effective now, so the financial statements that we've been issuing for 12/31/18 have this. It's just a paragraph with a little chart that shows these are the current assets that we have, our cash, our receivables. These are our expected uses of funds within the next 12-month period of time. We develop like a daily cash burn rate or something like that. And these are all useful tools. So the FASB is forcing you to do this for financial reporting, but really as organizations, you should be looking at this anyway. You know, we see well-funded organizations with lots of net assets on paper have trouble paying their vendors, have trouble paying their payroll that comes due every 2 weeks because they don't have liquidity. And it may require the board or management to think more carefully and creatively as to how they can free up liquid resources and not rely so much on long-term assets to get through the normal operating cycle. So as a result of going through this exercise, it might become more transparent to board members and financial people within the organizations that, okay, we might have a problem here that we didn't really realize we had before. That's something that we've come across. Restrictions on net assets have to be considered for liquidity because you may have restricted cash, but you're probably not going to use that cash for operations or within the next 12-month period of time. So it probably should be labeled a long-term asset on your statement of financial position, and it should pull out of your liquidity equation. So I know we just said a lot, but here, this, I don't know if you all can see this, but you can notice up top, I'll point, I have long arms. This is your current assets versus your current liabilities. You have a total of each. This organization looks good. They have $3.4 million of current assets, $800,000 of current liabilities. They have positive net assets of $3.1 million. We see a lot of organizations that have positive net assets of $3.1 million, but it's skewed. It's a little bit backwards, where the long-term assets are well in excess of the current, and they have cash problems, and they need lines of credit, and they need to make sure that their vouchers are being paid on time. And they're the ones that have to have their billing go out on time so that the cash is constantly feeding the operation. So this is what it should look like now. You'll notice too, or maybe you won't, but I'll point it out. These are in order of liquidity. Cash is cash. You can spend it right away. Investments, you can sell your investments and use the cash to pay your bills basically right away. Accounts receivable takes some time to collect though, right? So they're ordered behind cash. Prepaid expenses too, it takes a little bit of time. And then here in the current liability section, secured notes come first. So if we have notes payable, mortgages, things like that, they will come before accrued compensation, amounts you owe to your employees. They come in the order of priority and liquidation before your vendors and your accounts payable and so on. So again, shifting things around, adding labels, not all that monumental changes, but this is one that I think does really improve the financial reporting. The with and without donor restrictions, I don't know if that's really that big a deal, but this one, the liquidity and adding that note, I think is very helpful to the public and to you sitting on boards and running nonprofits. So what other changes did we have that came about from this accounting standards update? You now have to show intermediate measures, they're called. So you have to summarize your, yes, in the back before I go on.
Organizations cost collateralized assets support third-party benefits, whatever else. Where does that get documented?
Well, if they're just collateralizing or guaranteeing, it doesn't necessarily show up as a liability on their books. Okay, so the question is for a cross-collateralized situation, and there, I guess there's a demand note. Is there an actual debt though, or is this just a potential call for Yeah, if there's nothing actually issued, there's no liability yet, it doesn't get recognized on the books anyway. You would disclose that guarantee and that collateralization as a contingency, as a potential loss or potential use of cash in the footnotes. And you might want to include that in the liquidity note too. Likely not on the face of the financial statements until there's actually debt.
It could potentially show up on the face of financials if I'm not allowed to spend that asset, and I have to hold on to as long as the debt is outstanding and the debt is long term. That may now move that asset from short term down to long term. As Matt was talking, he had the current assets and the long term assets. That could potentially move the asset from it down to long term. I don't have the ability to spend the asset, but I'm required to hold that asset as long as the debt is outstanding.
I wouldn't say that's a result of this change, though. It should have always been done that way. You know, if it's held for a long-term purpose, it should have been presented that way. So in your statement of activities, which is your income statement, in a sense, we have to show operating and non-operating measures of operations of your performance. So the operations is generally your contributions, whatever programs you're running. Your non-operating will be your investment income and things like that. So again, it's just adding some more labels and presentation issues. A statement of functional expenses is now required for all organizations. This is, again, something that we've always done for all of our clients as long as they allowed it. Some of them fought us on it. Previously, only voluntary health and welfare organizations, which I won't bore you with the definition of, had to have the statement of functional expenses. Now everyone does. There's an example in a couple of slides. I'll show you what that is. You have to now disclose the methodologies used to allocate your expenses. So nonprofits presenting this way, functional expenses, functions are defined as either your programs, your administration, or your fundraising. Now, a lot of organizations have people and costs that cross those different categories, right? If you have a staff of 20, everyone's doing a bit of everything. Some people are doing strictly program, but a lot of people cross over. There have to be methodologies in place to allocate those costs across those different categories. And if you're getting grant funding, it goes even a step further and more granularly. You have to allocate those costs to different grants, right? And different programs and different vouchers. So this all, in a general sense, has to now be disclosed in the financial statements. So in the past, you would just disclose that we present on a functional basis our expenses. Now we're saying this is how we present our functional expenses, and here they are functionally allocated. Again, not a big deal, a little bit of additional information there. And if you're always doing that SOFI, I like acronyms, that statement of functional expenses, this really doesn't affect you all that much at all. But this, again, shines a light on the fact that organizations really need to consider their allocation methodologies for expenses, especially those that get government funding, especially those that may be scrutinized by a regulator someday. There are certain permissible standards out there for how you can allocate and carve up your costs between the different categories, depending on what types of costs they are. Investment expenses are now directly offset against investment income. So if you're making $1 million on a fund and you're paying an advisor 10 grand a year, you're going to show that 10 grand as a reduction of $1 million on one line. In the past, it probably showed up as a professional fee or investment management fee somewhere else in the statement of functional expenses. The last one, the cash flows, this is even too boring for me. So the direct method is one method of presenting the cash flows. It's probably not used by any of you. The indirect method is the abridged, easier, much simpler version. There were talks about requiring the direct version. Those talks failed, thankfully. So you can still use the indirect version. Chances are this doesn't affect you, so I'm not going to spend really any time on that. But here's now your statement of activities. Note the changes here. Operating revenue presented separately from non-operating revenue and expenses. That's about it. This right here, your program services, management, and general fundraising, that's your functional allocation of expenses, which are detailed, I hope, on the next slide. Yes. This is your SOFI. This should look familiar to most, if not all of you. This is now required. It wasn't necessarily required before. It was always best practice anyway before. So I would say there should be no impact on you. Excuse me. This should have already been in your financial statements. And you notice this is considered a natural classification, the type and inherent nature of the expense. And across the top is your functional expenses, program versus supporting. Any questions about this before I move on to the next standard? This is the one that affects you now. Statements that are going out, if they haven't already, for 12/31/18 in the next upcoming months or in the fall, if you're a fiscal year-end filer, should reflect all of these different changes. And if they're not, you should ask questions about whoever's providing those financial statements to you and why they're not meeting the new standards. All right. We'll move on. Revenue recognition. This, you can see, started back in 2014, and it's applicable to the year we're now sitting in. So 2019 calendar year ends, 2020 fiscal year ends. So if you're 12/31/18, this doesn't apply to you yet, except now the transactions that you're creating and dealing with here in 2019 should follow the new standards. Now, the issue with revenue recognition, this was really not intended for nonprofits. And that's what happens a lot with these FASBs, is they're dealing with the SEC in the public world where there's really very high stakes. Nonprofits are important, but it's different when you're talking about investment dollars, Wall Street, things like that. These revenue rec changes have been huge news for the accounting world and the finance world for for-profit entities, and it's now trickling down to nonprofits. So I don't want to go through it in too much depth, because I will force you all to fall asleep. But I will go over it in certain lengths. Not all of it applies to nonprofits. The whole point of this is the FASB was trying to collapse hundreds and hundreds of individual standards that applied to different industries into one uniform, overarching umbrella of standards that apply really to everybody. And then, of course, they realized, oops, doesn't apply perfectly to nonprofits. We have to supplement that with something else, which I'll talk about. So this one, again, it's important because this is affecting what you're doing now. What it does is it delineates between exchange transactions and non-exchange transactions. That's the key to this whole situation. Exchange transactions are those in which two parties involved in a transaction, a contract, receives some sort of commensurate value. Non-exchange, think of a contribution. Someone's giving you money. You're not giving them anything back. The altruistic benefit of giving you that money does not count as commensurate value according to the FASB. So in this case, if you have an exchange transaction, the accounting for that exchange transaction will likely be different. For nonprofits, where this really affects you, I'm probably going to jump ahead here because it makes it more realistic for you. This is where it really comes into play. I already said it doesn't affect contributions really. It affects memberships, subscriptions, products and services, royalty agreements, probably rare, sponsorships, conferences and seminars. You notice with all of these examples, whoever is giving you the money is getting something in return from you. That's the key point here. If you have that type of relationship with a customer, a client, a consumer, whoever, or a funding source, a little bell should go off and you had that. All right, the rev rec rules may have changed for me. So let's say you have some of these. Now what happens? Well, there's a 5-step. They're trying to make this simple and easy. 5-step plan to determining how to account for the revenue under these exchange type transactions. And this is what they are. Identify the contract with the customer. Within that contract, identify any performance obligations that exist that you have. Determine the price for those obligations, allocate those prices to those individual obligations, and then recognize the revenue as those obligations are satisfied. It sounds very simple, right? It makes sense. I have a contract. This is what I have to do under the contract. This is how much I earn from doing that under this contract. And I'm going to earn it as I do it, right? Seems simple. It's really not when you try to put it into practice. First of all, there's some issues with what constitutes a contract. It's all laid out here. I don't need to read this all to you. This is 50 pages of stuff you can bring back with you. Sleep on it later when you can. Contract has been approved by both parties. Everyone's committed. Payment terms are there. It's got real commercial stuff. It's got to be a legally enforceable contract is what it all boils down to, right? What are the performance obligations? It's a promise you make with a customer in exchange for whatever the customer is giving you, the money. This is what I will do to earn your money. And we have some examples after this that I think will bring it home. Here's some of them now. A housing-based nonprofit enters into a contract with a home buyer to build a home. You know, Habitat for Humanity, we have organizations that build veterans homes, things like that. That's a contract that they're going to build that home. This is Ken's favorite example. An animal rescue nonprofit enters into a royalty agreement. So a commercial company can use its likeness or its stamp of approval on dog treats. It's a contract. They're both getting something there. School, tuition, contract. You're earning that money. You're not just being given $1,000 a month to have that kid in your private school. Museum providing naming rights. Anyone really providing naming rights. The bank or whoever, the institution giving those naming rights gets something in return for that. I jumped to this side. I forgot there was a screen here. Determining the transaction price. This is not always so explicit and easy because a lot of times there's bundled services, right? And we'll show an example of that. So you have to use customary business practices to try to estimate the price for things It's the amount of the consideration an entity expects to receive in exchange for what it's promised to do, its performance obligations. As you go through and start really tearing apart your contracts, you'll see that it's not always so cut and dry. And what I will tell you, an overarching theme over all of this, is that a lot of estimates are involved, a lot of subjective thought is involved here too. So the accounting rules are set up in such a way that there is judgment involved with a lot of this. And you probably all have unique individual circumstances that you may be running through your heads right now. And if you ask me, I probably wouldn't have a clean answer for you, because I'd say I need to look at the contract, need to look through all of these different steps to see what's really going on and how it applies to you or doesn't apply to you. Step 4, allocate the transaction price. Again, here, if you have a bundled contract, one price with different obligations, how do you pull that apart and assign the value to each of those different performance obligations? It's not so easy. There's some guidance out there. You can use the adjusted market assessment method. Everything has to have a complicated name. It's the estimated price that you get in the fair market. You can do a cost plus. I know it costs me X to do this. I'm going to add on a 20% margin. That becomes my cost plus. Residual value, really not something that comes into play all that much. And then recognize the revenue as the obligations are satisfied. That's pretty self-explanatory, except sometimes when is it satisfied? When are there lingering effects that carry over? And again, you have to really look closely into this. Control factors come into play here. Once the recipient of your service or good or product, whatever, has control of the asset or the service or the material you give that person or entity, that's generally a good idea of when performance has taken place. This is if something's happening over time. If there's criteria being met over a period of time, it's not always so easy as you recognize all the revenue at once. So there's a few examples here. I'd really rather just jump to the actual examples that we put forth here. So example A, we have an education and advocacy membership organization. Has annual dues of $200. In the past, you would account for that a certain way. In the future, you're going to account for that differently. Some of you probably have dues. How many of you charge membership dues of any kind? Right. Jeff, we have to talk. So there's a few. The only direct benefit that the people get from having that membership in this example is they get a newsletter. And we project that newsletter would be worth $48 on the street, right? So how do we account for this now versus in the past? Here's the response. Go through each step. Use the 5-step plan. So identify the contract. So the newsletter is a contract with the customer because that's the only exchange transaction. I'm giving you $200, you're giving me a $48 newsletter back. The rest, I'm not getting anything for. Enjoy the $152. So what's the performance obligation? In this case, it's just that provision of the monthly newsletter. The transaction price we already established is worth $48, but we just made that number up. What's the $48? If you're not charging that, if you're not selling that newsletter, how do you determine what that price is? So the $152 is a contribution. In the past, I don't know if it's on here, it's not. In the past, we would have taken that whole $200 and recognized the revenue ratably over the 12-month period of time. So it's a little different. So if you're a membership organization that has this affects you, and you'll have to go through these processes and these steps. Talk to us, talk to whoever else you deal with on an accounting basis to make sure that they're accounting for this the right way. Any questions there? We have another example that's a little bit more convoluted. All right, so in this one we have tuition and fees. We deal with a lot of schools, not colleges so much, but schools. So there's tuition involved. Student registered for classes has a tuition statement of $10,000. That's what the full tuition is. There's also $200 of student fees, whatever those are for. And then you're going to have to pay for textbooks, $300. You can withdraw within the first 2 weeks of the semester. So there's a more complicated fact pattern here. How many of you have tuition? How many of you are from schools? All right, Jeff again. So this is important. What do? We go to the 5-step plan here. I'm going to go over. Yes.
I go back to what you just said about that dues. I have a dinner dance. Somebody gives me $500 to say you could do the dance. So $35 per ticket. I can give it a check. That's only $35 per ticket as opposed to $25. And I feel terrible about that. Now, that's the way I used to do it. Now you tell me, yeah.
Well, this is not IRS rules, remember. So sponsorships and things like that, they're considered exchange transactions to a certain extent, but you recognize the revenue as the event's taking place. That's when it's happening.
The contribution is the contribution.
Contribution is a contribution.
Well, they're giving you 500. You're giving them, they're telling you to donate the tickets to other people.
Yeah, but when they said that, then it's only $35.
Well, okay.
They gave you $500 though. Yeah, that doesn't sound right to me. So going through this tuition example here, the contract exists for the tuition, right? Commensurate value, you're providing education service in exchange for that $10,000, and the fees are part of the tuition, kinda, after the withdrawal period ends. It's cancelable at any point in time. There's no contract for the books, right? Because you're just $300, you're gonna buy books. Or the performance obligation. So the college has to provide those classes, the student services, and really access to the textbooks. What's the transaction price? Tuition and fees, $10,200. The textbooks, $300. Allocate the transaction price. In this case, it's spelled out pretty clearly. Step 5, recognize the revenue when the obligations are satisfied. So the tuition you provide over the course of the fall semester. So you would recognize that ratably over the course of the fall semester. $300 when the textbooks are purchased. That's when you pick up that revenue, and then you're basically done. So again, the takeaways here with revenue recognition are, it probably applies to some part of your business, probably not all of it, but some part of it. And it's worth looking into. And when you look into it, you want to look through contracts, you want to compare to this 5-step program and make sure that you're doing things the right way. Any questions there? Yes. A receipt or anything. So again, there's different rules for IRS substantiation of charitable contributions that person can deduct in the tax return versus what we're talking about here. From an accounting standpoint, I don't really think there's much difference. You know, whether you're picking up as a contribution or you're recording a sale of the same exact amount on the same date. I mean, it probably should be labeled sale of merchandise or whatever it is instead of contribution, but it's the same amount. It happens at the same point in time. Probably not a huge dollar amount, and it's probably not an exposure area. So here's the change. So I mentioned earlier how FASB said, oops, we didn't really think of nonprofits when we did this RevRec change. So in 2018, they came out with this accounting standards update. It applies to the same periods that the revenue rec rules do because it really resulted from that. So this clarifies the guidance between what's a contribution and what's a non-contribution. Contributions, like I said, non-reciprocal, non-exchange. You're getting money, not really giving anything in return. So it improves the guidance about whether transfer of assets, cancellation of liabilities, whatever, is considered contribution or exchange. So it provides criteria for that, a more robust framework for determining that. I would tell you the same thing. If it's something that's a little bit iffy, you want to look at it and you want to have your accountants look at the contracts, the donation acknowledgement, whatever it is that you have, to see if this is truly a contribution or if there's some exchange component to it that has to be accounted for differently, or if it has to be split out. So what's the changes here? Why is this ASU, so 2018-08 is the contributions versus the RevRec 2014-09? Why do we even care? Why are they separate? Well, commensurate value is what's important here. Exchange transactions qualify under RevRec, non-exchange qualify under this. So this ASU was intended to just clarify a lot of that. And like I said earlier, fulfilling the organization's mission does not constitute commensurate value. Benefits received by the general public is not commensurate value. That's something that we've heard from our clients in the past, where they try to explain that to us and say, listen, if it's just a part of what you do every day, you're not giving value specifically back to anybody. This creates questions about conditions versus restrictions. So conditional contributions involve barriers to be overcome and a right of return to the resource provider. Another question we get asked all the time by our clients, well, we have to provide a report that says what we did with this money at the end. That is not a true condition. That's just a throw-in. It's considered de minimis or immaterial. So examples of barriers for contracts that constitute revenue rec: levels of service, matching. If you get a matching grant, there's a condition before you earn that revenue. If you're in a government contract, you have to spend those dollars in qualified expenses. You have to follow a budget. You have to voucher, right? You have to subject yourself to the torment and torture of the people looking at your vouchers every month. That's conditions that you have to follow. Restricted contributions, as opposed to conditions, are a bit different, though they sound similar. They specify the use of funds after a certain date or for a more specific purpose than just your exempt purpose. Disclosure requirements, revenue recognition policies, usually note 1 or 2 to your financial statements. That will change a little bit now as a result of all of this. We'd probably disclose a bit more about how revenue is being treated as it affects your major revenue items. And your conditions and restrictions should be disclosed for major contracts and transactions, things like that. Again, the disclosure, we've always had as a firm the viewpoint that if there's something meaningful and significant and of a significant dollar value, it should be disclosed anyway, whether it says anywhere in the FASB hierarchy that we have to. So if you've been doing that all along, not a lot will change when it comes to this. This creates questions with government funding. And I was preparing for this the past week, I've read differences in opinion already on the new standards about how government contracts, principally reimbursement-based ones, are treated. Are they contributions or are they exchange transactions? I would say you have to really look into individual contracts and make sure that you understand fully what the obligations are, if there's commensurate value going back and forth, and whether or not those contracts should be picked up as conditional contributions as opposed to exchange type revenue. And it was a lot of words that I told you, don't blame me for this. I'm just the messenger, and I'm boiling down literally thousands of pages of minutia into 50 pages of minutia. Any questions about RevRec before I go into really the other last one I want to bring up? So lease standards. How many of you lease something? Space, copy machines, cars. Usually space is the big one and the important one. So there's new lease standards that affect everybody. Nonprofits unfortunately get thrown into that mix. And what the lease rules in the past were, you had two forms of leases. You had capital or operating, right? Those of you who have office space, you've been recording your office rent as rent expense, right? You don't have your building that you're renting on your books as an asset or as a liability because it's not debt to you, right? It's just a lease. What the new rules are requiring is that, I'm 9 seconds over my allotted time. What the new rules are requiring are that leases be valued and put on your books as an asset and as a corresponding liability. Now this has very large scale ramifications because one, it's hard to calculate and go through. We probably won't have the time to go through it here. But more importantly, once you start throwing assets and liabilities on your statement of financial position, you may have debt covenants that now you used to be in compliance with and now you're not because the denominator on it may have gone up because of your liabilities. So there's a lot of conversations that will come about from dealing with this lease standard. One of which is you might have to talk to whoever is funding you or lending to you and make them aware that my financial statements are going to look a little bit different in the future. So this doesn't affect us yet. It's effective for 2020 calendar year ends and 2020 fiscal year ends. This has been going on since 2016. This is something that public companies are now dealing with. It's been a nightmare for them. The rules are complicated, they're convoluted, probably even more so than revenue recognition. The whole point of this is, though, I'm going to skip. All leases will be accounted for unless they're short term. If they're 12 months or less, you don't have to worry about this. If they're 12 months or more, they have to be included on the balance sheet as assets and liabilities. And the way you calculate that is a discounted present value of all the future payments pursuant to that lease, all the fixed payments that you know what they are. And then what you'll do over time is you'll, in a sense, depreciate or amortize the value of that lease asset. They call it a right of use, an ROU asset, over the course of time. And you pick up an interest component on it too, interest expense, because you're discounting it. So now I'm already throwing a bunch of terms out there. Now leases don't really spell out discount rates, right? You have to figure out what that rate is. More estimates, more subjectivity, more annoyance. That's why this is not so fun. There's extension provisions, right? So what's the term of a lease? Is it 10 years or is it 15 if I have a 5-year renewal that I'm going to do? And then there's rules for deciding if that 5 years should be exercised or not. And you consider that you're definitely going to use it. So there's multiple layers of complexity and nuisance that come with this. Again, I will tell you, have someone who understands this stuff. If you don't want to learn it all yourselves, I completely understand. I have someone who understands this stuff. Look at your leases, make sure that you fully understand the terms of them as they relate to the accounting standards, and that your books and records are accurately presenting the new standards as they relate to all these leases you have. What I would tell you is copiers and things like that, if they're immaterial, throw them out, keep recording them as operating leases. The guidance even kind of says something to that effect, that this is meant for major assets, major lease obligations that in the past weren't on the balance sheet. So the whole point of this was in the back of financial statements, there was always just a chart that says this is what we have to pay over the course of time. And FASB has really changed its tune and said, well, that's really the definition of a liability. It should be on the books. You possess the asset, right? The lessor, the landlord can't really use the asset while you're occupying it. It's kind of your asset as well as any other asset you own. So we have to throw it up on the books. All right. So here's the general way that we account for these leases. The lease liability, I said, is the present value of the future lease payments, variable and contingent payments. Another factor, another complicating factor. Your lease usually has escalations, right? 3% a year, or it's matching the CPI or something like that. Generally, the rule, not always, is if it's fixed, it has to go into this calculation. If it's variable and based on something that you can't accurately predict or assume will happen, you don't factor it in, and you record those as expenses in the years in which you get hit with them. But then there's questions about real estate taxes, common area maintenance, insurance, all these other expenses that come with leases that are in your lease, but maybe aren't in your lease. And the answer there too is it depends on the nature of those expenses. If you're paying the landlord's portion of real estate taxes, whatever they are, it doesn't go into here. If it's just part of your rent, it does. So you can see there's so many layers of nonsense to deal with, and it really would behoove you all to either look at it very closely yourself or bring someone in to look at these things closely. The asset, so we have the liability established up here now on the asset side. It's really just the sum of the lease liability plus any costs, whether it's legal fees, closing fees, things like that, plus anything that we may have prepaid to get you to that asset value. That seems easier because it's dependent on the lease liability. So now we have the liability and the asset established. How do we record the expense over time, right? Because right now it's easy. You cut a check, it's rent expense. Boom, I'm done. It's not like that anymore. So now we have to amortize the right of use asset, depreciate it in a sense over time on a straight line basis. So that's fairly easy if that's considered a finance lease. So the finance and operating lease distinctions, which used to be capital and operating lease, still exist because while all the leases have to be capitalized as assets and liabilities, how they are presented in the cash flows and the statement of activities differs, whether they're capital or operating. So I don't know if you guys remember, there's a 4 and now a 5-step rule for whether it's a capital lease or operating. You know, is there a bargain purchase? Is it a unique item that only you have? Are you using 75% of the life or 90% of the fair value? All these things, they still apply. You still have to deal with that matrix of questioning before you get to an answer there. So you can see it's different for a finance lease. It's easier to record the future expense for an operating lease. It's dependent on the liability, and you'll, like I said, pick up an interest expense component based on the discount going away. I'm saying so many words that probably not really registering. Other considerations for the leases. I mentioned there's other non-lease components, consumable service costs, maintenance, things like that. They should be accounted for separately. So not everything gets lumped into the lease to be put on your balance sheet. Some things still will just be expensed as rent or something similar. Short-term leases, this one's important. Like I said, if they're under 12 months in length and they don't include a bargain purchase option, you do not have to do this. Leases that were in effect before this ASU came to be and became effective don't have to be reanalyzed. You can say that anything from the date of effectiveness, which is 2020, whatever, future leases will do this for, and we'll keep accounting for the old ones the way we were. So that's good. That's a bit of relief. So really, any new lease that comes across your desk, your accountants have to look at it now too to make sure that they know how to account for everything that's going on in there. And of course, there's expanded disclosures, qualitative and quantitative, the lease terms, conditions. That all should have pretty much been in there anyway. But now, because we have this weird asset and weird liability dependent on interest rates and this and that, all of those different factors have to be disclosed. So your financial statements will just continue to get thicker and thicker. On the plus side for lessors, owners of property who are leasing it out, not much has changed. It probably doesn't affect many of you anyway, but not much has changed there. Yes.
If I'm a nonprofit organization and maybe I sublease space or something like that, that makes me go from a lessor and a lessee.
It's complicated, is honestly the answer, because it depends on the nature of both leases and the use of the asset and whether or not the original lessee still maintains possession or control of any part of that asset versus it's completely subleasing it out. So you might be creating multiple lease contracts that have to be accounted for differently. So there's no clean answer to that, or probably any question that is along those lines. We made it through the 4 that I wanted to talk about. So now we have 5 others that I will breeze through because they probably don't apply to you. Does anyone have intangible assets or goodwill? Are you aware of that being on your books? I'll ask that first. So goodwill is generally the excess that you pay in a business combination or something like that, a merger, over the book value of something. And that goodwill sits on your books and has to be impaired. Has anyone heard of an impairment test for goodwill? No? If you haven't, I'm not going to waste your time. No, just forget it. This makes it easier though. So the one thing that would help you doesn't apply to any of you. That's your takeaway. There's more here too for goodwill. These are far out anyway. They don't affect you until 2022 for certain ones here. This one I want to talk about a little bit because it might affect you. Anyone heard of CECL? Another cute acronym, CECL. Any of you make loans as part of your organization for whether it's a housing type situation, anything like that? No, this doesn't really apply either. What this is, and you might hear about this in coming years, it's very far down the line. You might hear banks, Capital One Bank, probably complaining about this because it creates a whole mess for them. Right now, estimating losses and future bad debts on receivables, like loans type receivables, you base it on when you think a loan has gone bad, you would record that expense. This is saying you have to really project out into the future and use assumptions based on historical data, how much of a bad debt loss you might experience, given all the data you have. If this negatively affects their business, it's going to be a problem. It probably doesn't apply to you guys. So we have some affordable housing type organizations that make loans to individuals, at below market rates and things like that. This would affect them, but I guess not you. And the rest, I think, is all about that also. Oh, here's one for does anyone have defined benefit plan? Retirement plan for which they have fixed payments out to retirees. So for these, you probably get an actuary report, right, that shows the projected benefit obligation, how much you will owe under this DB plan and what the estimated cost is each year and things like that. So this just kind of changes the presentation of the expenses that affect DB plans, defined benefit, and the reporting of the disclosure of certain aspects of defined benefit plans. But again, if it doesn't apply to you all, I'm not going to waste your time. And that's really it. Whew. Any questions about anything? If you have specific questions as you start to digest and implement some of what we talked about, we are all happy to help answer it. This is the stuff that you pay accountants to know about and you don't want to know about, right? Because it's so complicated. So thank you, everybody.